and I'm going to record this episode.
Okay. Should you want me to be on camera or no? I can be.
I'm gonna put my camera off as well, or however. No,
Yeah,
okay.
I think you have to give me permission or something like that. Oh, no, maybe not. Here I come in. I'm coming in.
Yeah.
Slowly. Oh my God. Yeah. I don't have all my lighting set up.
So I'm gonna make an intro, and then we can start talking.
Perfect.
Looks great, that Tradier background over there.
Don't forget the trade hawk.
Hello, everyone, and welcome to the. Sorry.
Sorry about that.
That's fine. Welcome everyone to the webinar of how to limit risk by trading options. We have a very special guest. It's Lex from Tradier Inc. I don't want to say your last name because
I was going to say, don't even try that. That's going to mess you up.
No, Luthringshausen.
I'm typing it in the chat if that's okay. Then let everyone try to pronounce it.
Luthringshausen. We're very grateful to have you as partners, and of course, you've been part of this ride and this renovation of PipTrade, and it's always good to collaborate with companies like Tradier. So that I think it's one of the most innovative brokers on the market, and certainly one of the biggest in terms of volume. Mm-hmm. And if anybody that trades or participates on the PipTrade challenge, all the trades are going through the Tradier platform. And Lex is a great friend of mine, and he's 35 years trading. Lex?
Yeah, thereabouts, right around that number. That's scary, right? I'm not getting younger, is what you're trying to say.
You know about trading. That's
right.
The purpose. So welcome, Lex. Thank you very much, as always, for being here, and it's a pleasure to have you here.
Thanks. All right, so I'm going to go through. I'll stay with I think I have a position in Twitter. I think everyone knows Twitter, probably, right? Mm-hmm. And I will, I'm long 1,500 shares of Twitter, so maybe we'll just go through some hedging ideas there. Hopefully there's some questions, and everyone pretty much knows options, or should I, what do you think, Juan?
I think we can, you can go through it and maybe some questions. Right.
Okay. Yeah. Can I put a few plugs out?
Yeah.
Okay. Plug number one. So everyone, I'd love to have you join us on Options Brew, which is a show that I host on Wednesdays. Now, it's not every Wednesday. You can get an email if you'd like. But what we do on those shows, and I think Juan's been on one or two, has come to them. Juan, you're going to be a guest one of these times too, by the way. All right.
My pleasure.
But Options Brew, we bring in educators and mentors and people who can teach you things. It's really interesting stuff. It's always a little different. It's streamed through YouTube. So please subscribe to the channel. It's Options Brew by Tradier. And our Trade Hawk channel is just Trade Hawk by Tradier as well. So all kinds of interesting stuff there. Love to have you on an Options Brew down the road. Next one's in 2 weeks.
I just want to make sure that every time there's a new Options Brew, we let every one of our users via email and Facebook to join. So make sure to look at your emails and you'll have the invitation. It's very nice for.
Okay. Awesome. Okay, so I glanced at a quick question here. I don't know how quick this is going to be, but can you explain about the use of Greeks to understand options? Is that something I could tackle? Juan, is it okay with you?
Yeah.
Okay. Perfect. All right. Let me try to hit some of these questions, and let me go through just a simple example of hedging. Okay. Using trade-off. So I probably should share my screen, right?
Yeah, you're allowed now.
Okay, I'm on my way. Okay, how's that looking? Anything happening on your end?
All good.
All good? All right, awesome. Let me do one other thing. I want to draw. Can I draw?
I think you can. Give me.
Yeah.
No. We had a couple of incidents of people
Oh,
drawing.
well, we don't. Yeah, I'll only use arrows. I'm assuming everyone can see my screen, right? I'll pull the chat up too, so I can watch that.
Yeah, we can see that.
Okay, so no, maybe no drawing then.
No, not at the moment.
Okay.
It will take me a little bit more.
Okay, let me know when it comes in. Okay, so what we're seeing here is TradeHawk. Okay, so TradeHawk is a trading platform, right? And a lot of you probably familiar with it. It's very option centric. That just simply means that most of our users tend to trade options first and probably stock second. What I mean by that is options become their main reason for making trades. Okay. And listen, there's a host of things that you can use options to trade for, right? And it can be directional, it can be non-directional. And the stock part of options trading becomes a hedge. Okay. So unlike what I'm going to talk about today, quite frankly, is we're going to talk about hedging a stock position. What we did in the options market is we did the opposite, believe it or not. So what we did is we took our option position and typically hedge them with stock. Whereas today, you as investors, and you're learning how to buy and sell stock, let's say, you can mitigate some of your exposure using options. Okay. So let's have a glance at it. Let me just explain a few things here. I'll just use my mouse until maybe Juan can figure out how to give me that annotation tool. Can you see my mouse? I'll go slow. So what I have in front of you is what we call the Hawk Command Center. This is my specific trading platform. Okay, meaning I've laid this out like this. Okay, I typically do demos with this one, but there's a lot of things in here that most users probably wouldn't need. Okay, and you can take that stuff out by clicking white X's and removing them. But for purposes, I'll leave it set on the things that you would use normally. So over in this top right section is my portfolio page. Okay, what I'm going to do is I'm going to expand it to show you what we're going to talk about. What you're looking at here is you're looking at my inventory of positions. Now you can see I've got Apple, Cisco, Facebook, FXI, IWM, etc. We're going to talk a little bit about Twitter today. So in this thing, if I hit all, okay, this is the wow, what's going on here phase. And that's why I keep it in symbol mode. This is the itemization of every one of my positions. Okay, this is everything. So this is overwhelming. This is mind numbing when you look at this. How do you make heads or tails of it? Well, one of the folks asked about deltas. That's number one. The other great thing that you can look at in these things, and let's just go to Apple. You can look at P&L too. So I can see an Apple. And if you look at this top row in Apple, this is where my mouse is, if you can see that, it shows that I'm up $53,000 in Apple. That's great. That's wonderful news, right? How did I get there? I got there by the sum of all these positions right here. And these are all hedging type things I use with options. Okay. So you can see that not everything's a winner. I'm down in this October month with all these spreads here, about $125,000. Holy cow, that seems like a lot, right? But I'm up in other places and I'm up enough to offset that loss, okay, with my Apple stock and come out net positive in Apple of 50, 2-ish thousand. It keeps changing, with the marketplace. Okay. So how do I keep my handle on this? If you look way over to the right, you have a delta column and a theta column. Okay. So let me talk a little bit about Greeks, and I'm going to go really slow. Okay. Delta, what does that tell me? To me, delta next to Vega for me is something that's super important because it gives me an equivalent share of stock. If I'm short deltas, it's going to feel like I'm short stock and I want the market in that particular stock to go down. If I'm long deltas, it's the opposite. I would think that I'd want the market to go up. Okay. So you can see in all of these stocks, and let's just go back to symbol mode. If you look straight across in the delta columns, you can see I'm short 86 deltas in Apple. For a position that's up that much money, that seems like a real small number. It's very close to zero, correct? That's what we did as traders, okay? We tried to be what we call delta neutral. What does that mean? That means your deltas at the sum of all of your inventory in a particular stock tends towards zero, okay? And you can see that some of these positions are a little off zero. What happens with this revolve one right here? What's going on here? 10,000 deltas. Well, that's all my stock. Okay, so I just believe in revolve, and I just want that to go up. I have no hedge on in revolve, so therefore I'm exposed delta wise. Okay, so if you remember, stock is a 100 delta. It's 1 for 1. You make or lose every penny it goes up and down. You lose by that amount. Whereas Greeks in options, deltas are a fraction. So a 50 delta option when you have that will move 50% of the stock price. Okay. So if I had 100 deltas in stock and I wanted to hedge it with options, I could do that with 250 delta options. What else could I do? I could do 100 delta options. I could do 425 delta options. I think you see where I'm going. Okay. So let's look at Twitter. Okay. Let's go over here. And please feel free to ask questions on the chat. I can see them. I'm not sure, I'll go back and answer them as I see them.
You can
Twitter.
try and draw now, I think.
What's up? I can draw now?
I think so. Let me know if it works.
Should I stop sharing? I don't see the annotation tool. I'll stop sharing and do it again. Share again. Here we go. Sorry. Yeah, it doesn't show it. That's okay, Juan. I'll keep going. Okay, Twitter, 1,500 shares. So I'm looking over here. Twitter, 1,500 shares. Happily, I'm up $7,800 in Twitter on 1,500 shares. Okay, so in TradeHawk, we show your cost column, which is this one right here. I own Twitter at 31.24. Okay, that's where I bought my composite 1,500 shares. It's currently trading based on the value column at 36.45. So I'm up, what, $5.21, right? 22 cents. And that number comes out to be this when you multiply it by 1,500 shares. So now I want to hedge that, let's say, and I want to kind of keep this position. I'm a long-term believer in Twitter, and maybe I want to protect my downside. How do I do that? A couple ways. You can sell calls, you can buy puts, you can sell call spreads, you can buy put spreads, etc. So what I think a lot of folks do is they have a belief in something in a stock, and they think it's going to go up or down for that matter. But let's just talk to the positive side of going up. And what they'll do is they'll try to enhance their income on this 1,500 shares of stock. How do they do that? Well, they'll go to Twitter and they'll sell calls, because remember, options are by nature a decaying asset. Okay, what does that mean? That means as time goes on, okay, these options will waste away until they get to expiration, and they're either worth what we call parity, okay, which is the difference between the strike price and the current stock price, or they're worth zero. Okay. So if I sell something for $2 and it goes to zero, I make $2 on that option. So what you'll see a lot of folks do is they'll have this 1,500 shares and they'll say, okay, I want to sell some calls against this. And they'll go out, I'm going to move out, and in TradeHawk, I'm moving out. I'm just pushing the arrow up here and I'm picking a month. And let's just, for randomness, say, let's go out to October. It's 74 days away. Okay, in Twitter. And we can see the option premiums here, right? Calls are on the left of the strike, puts are on the right. So what I want to do is I can sell some calls to get to 1,500 deltas. And if you notice, I've got 1,500 deltas long in Twitter. I've got no options on it. Otherwise, it would show them here. So I can start building options, putting options in here, or putting a spread. So what I'm going to do first is I'm just going to sell a call. Okay. And I'm going to pick the 40 call because that's a little bit away from where it's trading, 36.45. So the 40 call is trading $1.60, right? So that's $1.60 of premium, okay? And if I sell 15 of those to match my 1,500 shares, I'm going to get 15 times $1.60 times 100 for that premium. And if that decays to nothingness, I enhance my return on this Twitter, right? So if I put that out there, I can do that in TradeHawk by simply making this a 15 lot and sending this out. If I get filled, wonderful, it'll appear here. And now I'm hedged 1,500 shares of stock by 15 calls. Remember, calls multiply by 100 in the world of options. Okay, everything's multiplied by 100. Okay, so 1,500 shares, if I get assigned on that, meaning that turns into short stock because I sold those, I'm going to get 1,500 shares short against 1,500 long, and they're going to net out to 0. Now, I might not want that to happen. So some of the little more complex things that can occur is I might have to what we call roll that. So if I'm in danger of getting assigned on that option as expiration nears in 74 days, what I want to do is I want to do a spread, and I want to buy in those shorts and roll them out to another month. I'm sure if you've watched some of the news channels, they talk about rolling things. That's what that means. So you buy in a short, roll it out to a new short in a farther term month, so there's no danger of getting your shares called away. Okay. Juan, does that all make sense at all? Let me know if I'm going too fast or that's way out off the board here.
No, I think it's all good. We have the questions here, so.
Should I go over a few of them? Some of them are in Spanish and I can't.
Yeah, not many so far.
Okay. All good. I got it all good. I'm going fast. Options good. Okay. Should I go over some of the sub Greeks too, or are we good with delta? Should I talk about gamma theta?
Yeah, I think.
Okay.
We'll talk about that and.
Okay, let me go. So let me take one quick step back. Can you make a trade, please? Yeah, I'm gonna make a trade. I'm gonna do it in Twitter. So here's what's gonna happen. I want to hedge this trade. Okay. So without getting crazy and too complex, remember I've got 1,500 shares of Twitter that I'm long. How many deltas is that? Anyone know? It's 1,500, right? So stock 1 for 1. It's 100 deltas for stock. It's 1,500. Okay. So I got 1,500 long deltas. I want to hedge my 1,500 deltas with options, and I need to get short 1,500 deltas, right? To make 0 deltas net. So what can I do? Let's do it with a spread. So what I'm going to do is I'm going to choose the 40 strike, like I said before. I'm going to put it in here. Okay. And I'm going to do 15 because that's what we decided was what we have. So I put 15 into my spread ticket. And if you notice, that's 540 of my 1,500 deltas. Notice the short sign out there in the delta column. Okay. So if I were to do just this 15 lot, I'm going to get 1,500. I'm going to get, 500 deltas of my 15 hedged. It's going to mean I have 1,000 more to do. What else could I do? I could do a put against that, right? So if I grab a put in here, okay, again, let's go 15 times on this. Let's see what my new deltas are. Getting closer, right? 960 deltas short versus my 1,500. So what I've done here is I've created a long put and a short call. Okay, now I've done it 15 times. So this is called a zero cost collar. And I did it so that the premium is right around 0. I got a little bit of a credit in it, right? So what happens is that in between the 33 strike and the 40 strike, I have my shares. If I inch down to the 33 strike, I'm gonna lose a little bit of money because this isn't gonna participate that much. But essentially what happens is that I protected myself and my 1,500 shares from going down to 0. I'm protected because I'm long 15 puts that will go 1 for 1 for the stock eventually. Or if it goes up to infinity, I'm going to be taken out by my short 40 strike, okay? Because I'll have 15 of those on. So that's one hedge. Keep in mind that this can take you out of your long stock position if it goes beneath the 33 strike or above the 40 strike by expiration. Something to be aware of. If I take this 15 lot off on the put side, now I just have a short call. I've got risk to the downside. I'm not being protected by the put, but I'm getting a little bit of flavor and protection from this $1.60 call 15 times. And you can see the delta difference, 540 versus 1,500. Let's put this out here and see what happens. Okay, so I'll send that out here. Oops, I got to send 2 legs on this one. I'm going to do, let's just do a straight option. So I'm going to send this out here for $1.59. Market is 57.61. So I'll go somewhere in between. It's the midpoint in this case. Sell to open. So it goes out there. This is in the marketplace, sitting out there. I'm not filled yet. Okay, it's open order here, waiting to get filled. Okay, so that's how you'd put out a trade. Okay, just to show that. Okay, what other things can you do? And again, Juan, I don't want to get too heady, but should I talk about a call spread? Is that?
Yeah.
Is that okay?
Yeah.
Another spread, and look at most people when they're long stock, they tend to take into account, they try to take advantage of theta. Okay, so that's the next Greek we'll talk about, theta. What is theta? It's called time decay. And time decay is a metric that measures how your options rot and decay actually away. Okay, so as time goes on, the options get cheaper and cheaper and cheaper. And that theta kind of burns like a wildfire until it goes to parity or nothingness. And that's called theta. So people who try to manage long stock, they tend to want to have some positive theta working their way. So as that as that option decays, they're collecting it because they sold it. Okay, so that's what theta does. It measures the time decay of your position. Now, if you have a bunch of options on, positive and negative thetas will offset against each other. And your longs will be negative thetas, your shorts will be positive thetas. Hopefully the sum of that stuff is a positive number so that as it decays, you make some money. Okay. The question is, would theta be equivalent to depreciation? Yeah, absolutely. Depreciation in the option, though, make sure that's clear. It's not depreciation in your asset, the Twitter itself, the stock necessarily, but you're using that depreciation to offset just the sort of sitting around of Twitter or slightly downward move of Twitter, using that depreciation to enhance your return on your trade, if that makes any sense. Okay. So I just got filled. Awesome. So as we're talking, I got filled. So let's look at what our new metric is. Okay. Remember I said it was about 540 deltas. So with TradeHawk, it had made a little ding. I don't know if you could hear that. I got a fill order. I sold 15 Twitter calls, OC40s at 159. There they are. I'm short 15 of those. It's added to my position over here in the portfolio page. Notice there's that 540 deltas. I said I'd get short, negative sign. Okay, let me expand this so we can see this. So there's my 540. Remember, I was long 1,500 deltas in Twitter. Okay, I've just hedged it a little bit. If we look on the Twitter line way over here, I'm now long only 958 deltas. So I've taken away a little of that downside now. I've taken away some of those long deltas, and I've reduced it by selling a 15 lot of calls. Now, can you sell more than 15 calls? Sure, you can sell a lot of calls if you want. Now, that's governed at the brokerage level by how much money you have in your account. Okay, so once you start selling more than 15, you're selling more units. So you start having risk to the upside in that example. Okay, so you have to be careful there. Probably I'd say in the retail world of trading, online trading, selling extra units of things, you have to have a decent amount of money in your account. I think it starts at about 25,000. That's kind of the rule of thumb to be able to sell units. Okay, so that's why I just sold 15. Now what I can do is I'm going to minimize back down. Let's go try to buy the put now. Okay, and let's try to buy a put about the same price so I don't have any money tied up into it. Okay, so I'm going to go out, look down on the put strikes. Here's the strikes. Okay, the stock's trading right around the blue line. It's now around 36. So I'm going to pick this 33 line because that's a little less than 160. So it's 145-ish. So I'm going to click on that. I'm going to just put my option ticket, click on it, fills in the price I clicked on. I need 15 of those, right? And let's see, 145. Let's try to get 146. What the heck, right? So I'm buying these. Remember, I'm buying puts. Puts profit when the stock goes down. So that's what I'm trying to protect against because I'm long that stock. So that's out there. It's working, not filled yet. It's about 418 deltas, which is going to make about 1,000 of my Twitter. And I'll be fairly comfortably hedged in my mind after that. Okay. The other thing you can do relative to that unit thing, don't forget, you can use spreads to hedge this. So if I didn't want to sell this call because I felt that was too risky to my upside, I could buy a put. But what's the problem with buying a put? We just talked about it, right? And someone just said it's like depreciation, right? Yeah. If I just buy a put, it decays, and decay is losing money if you're long that stuff. So if I buy a put and I sell another put, kind of cool. I can have a little offset there. So to protect yourself to the downside, you'd have to buy a put spread. So if I did that, I could choose like maybe saying, hey, I'll buy the 35 put and sell the 32 put. Notice instead of just paying 218 for just that bare put, I can sell another put about 119 and only pay $1 for that instead of $2. Now, what's the upside downside, right? The downside is I'm only protected for the strike difference, the $3 of difference. So between 35 and 32. If this stock keeps going lower and lower and lower, the most I can make is the difference between the strike less what I paid for it. So in this case, I can only make $2, right? Because at some point my long and short are going to keep up with each other and they keep matching and I make the difference. So that's one downside of that spread. I'm going to clear that out. The other thing you can do, you can sell a call spread against it. So if I said, let's sell the 41.44 call spread, that's a credit spread as well. I'm going to make that credit. It's only 57 cents. That's all I can make on that because I've got the risk of the stock running way, way up. And I'll lose the difference between my call spread on this credit spread and the credit that I got out of that spread. That's my max loss there. These are just income enhancement type tools, right? So it's for, most people do with that kind of trade is they say, you know what, my stock's moved a lot. I want to kind of protect it, right? And I want to kind of enhance my income. That's what that's typically used for. Now I got filled as we're talking on the 15 lot. Okay, so now I'm long 15 puts, short 15 calls. Okay, so I've done this for just about zero cost, a little credit. You can see my theta over here. Let's expand it. What's my theta? It's only $2.28 positive. That's not that much, $2, right? But that's good. I'm not paying for it. So now I'm protected. If the stock goes to infinity, I'm going to get taken out by my short 15 calls. If the stock goes to zero, right, I'm going to be protected by my long 15 put. So I'm protected now. There's a little zone in the middle where I have a little bit of an issue, okay, because it can drift around. Stock can go down. I don't get the oomph out of the put. These go to zero, and I can lose a little bit of money in between, but I'm really protecting myself for the big, bad, nasty move, okay? So if I put this spread in here, let's see what this is here. Let's put this in. See if I can get this in here. I'm gonna flip this over. We're gonna show you what the dynamics of this looks like. And then I'm gonna do buy right. Is that right? Okay, perfect. Let's do. Okay, I'm gonna put 15 of these in here. That's what it looks like. Let's go to what if. Let's see what this thing looks like here. So let me go here. Notice the difference here. So now remember, I had 1,500 shares. Okay, well, you know what 1,500 shares look like? It's a vertical line right through the middle point here. And I lose dollar for dollar to the downside, and I make dollar for dollar to the upside. So now what I've done is I've done this thing, what we call a collar. I'm long a put, short a call, equal amount to my shares. So you notice that what I've done is instead of losing dollar for dollar, I've stopped it out. Okay, so I've got a maximum loss I can have. Okay, and I've got a maximum gain now. So I've essentially said to that 1,500 shares, I said, okay, you're done. I've stopped the bleeding of sorts, and I put an end to both sides of this spread. Okay, the most I can lose is defined. The most I can win is defined. And don't forget, you can always roll this stuff. So if you're trying to hedge for little intermediate disruptions, great. This is a great spread to use. This is what a lot of money managers use to hedge stock positions. They do this a lot. Okay. And what they'll do is as time comes near, they'll roll this stuff out. What does that mean? It's going to disappear as expiration comes. So they'll take and say, okay, I want to roll this out. This is the last thing I'm going to talk about. I'll answer some questions. I want to roll this out. Pretend expiration's coming. So I need to sell these out. So that's this side. I need to buy these back. That's this side. Notice it's closing. And let's go out to a new month. Let's go out to January, 165 days, and do the new trade. I'm going to pick this guy and this guy because they're close in price. So now what I'm doing is I'm closing out that October trade and I'm moving it out into another month, in this case, January of 2021. So you can do that endlessly with options, and it's very effective when you're managing a stock position, okay? Juan, how are we doing? Are we okay?
Yeah, we're all good. All good.
Okay. Yeah, so I think that question, do I use options mainly for protection or for speculation, right? I would say this, okay? Think about what it costs to do stock, all right? So there's a good answer for this. And I'm going to pick Apple. Everyone knows Apple, right? So if I pick Apple, and let me show you the difference here. I'm going to put this on preview. Okay, what I'm going to do is I'm going to do 1,000 shares of Apple, and I'm going to preview it. Okay, let's see if I can get this up here. Previews. Sorry. Oops. Okay, that's on. Let me try this. Okay. Look at this 1,000 shares of Apple. This is important to understand. This order cost is $436,000. Okay. That's how much money I need to have in my account. They'll probably give you a margin on half of it. So let's say 215,000 on Apple. So this is an answer to the question about speculation versus using it for protection. I use it for speculation also. And here, my point is this: it costs me a lot of money to do 1,000 shares of Apple. Okay. What else can I do with Apple? I can go to Apple options. And for me to get the same equivalent purchase of 1,000 shares, right, I'd have to buy a 50 delta option, right, 20 times, or a 100 delta option 10 times to get 1,000 deltas. So let's just pick one and show what the margin is on that. Okay, so I'm going to pick this 440 call on Apple, and I'm way out in January, so I've got plenty of time. And I'm going to just click, let's do the 49, it's closer to 50. I'm going to click the 450 option I decided. And let's buy, remember that I need to buy 50 delta. So that's 20 times 50 is 1,000. Okay. So I need to have 20 options to equal my 1,000 shares. Okay. How do I know that? Well, I put 20 in, 981, close enough to 1,000. We're not going to split hairs here. And I'm going to put it on preview, and let's see what that margin cost is to buy this option. Look at the difference. Order cost, $62,400 versus, remember, $436,000. That's a massive difference. I get to speculate for a lot less cost, and I can hedge this cost against selling some other options against it. Okay. Bad news is this option decays. Like we talked about earlier, it depreciates and time goes by. It's like a burning, wasting asset. That's the bad news. The good news is you can only lose what you pay for this option. That's it. Okay. With stock, you can lose all the way down to zero if you own that stock. So there's a big, big difference. So I guess the long-winded answer to your question is I use it for both. If I have a feel for direction, okay, with a stock, and I want to speculate, I will 100% use options. Okay. Occasionally I'm given stock because my positions expire, kind of like with Twitter here. And you didn't get to see I had options against this. So I typically use options almost all the time to speculate as well, to protect. Okay. Okay, Juan, I think I'm gonna stop there. That's probably like crazy amount of information in terms of understanding.
Yeah, I think you were very clear on both things. One is you can hedge your risk by using options, or you can trade a stock or like make profit on the movements with a lot less amount of capital.
That's right.
So if you, of course, you don't want to go and, I don't know, sell a naked call or sell a naked put, because then you might be into trouble by the leverage. But if you understand how options work and you understand how you can limit your risk, and if you want to get exposure to Apple, you can either buy the stock as you mentioned it, or you can buy the call. And if you buy the call, you have a much more limited amount that you need to put upfront, and also you're limiting the downside as well.
That's right. Yeah, and there's not to mention there's a host of spreads you can use to offset some of those theta costs. Long bull spreads on the call side, short put spreads, which if you're bullish, so they call them bull put spreads, bull call spreads, right? Those sort of things are great as you learn more and more about options to just mitigate some of those theta problems that you have. Okay.
Sometimes people see options, and this is something that that's why I love to have you here, because people think that options are very, very speculative, and it depends on if you know how to use them. If you know how to use them, it's a good way to getting exposure on any given asset. If you don't know how to use it, you're probably better off not doing it. I would say, but it's not rocket science, I think.
Right. No, it isn't. It takes a little understanding, right? A little practice. There are plenty of educators in the space, in the option space. Lots of folks out there who actually do this for a living, teach from the most beginner level to the most advanced level. So if you do some searches, you can definitely find that. But yeah, I mean, look, I've been doing this for like as Juan said, 30 plus years. And options have changed over 30 years. Obviously, I stood on a trading floor with a trading coat on and yelled and screamed like you might have seen in an old movie. That was what I did. We yelled and screamed at each other and had hand signs, and we didn't have computers like this to manage our option inventory. We had to do it all by hand on a piece of paper. We just kept using our calculator and scratching off numbers and getting close. Nowadays, especially with online investing and trading, the tools are terrific. They really are. And your access to option market and liquidity is outstanding. And the cost, the cost is unreal, right? It's really, really reasonable to invest and trade and manage your risk using options in the marketplace now. So
yeah, I think what you have here, I always say that, but it's one of the best, if not the best, options trading platform for retail investors, and anyone can join and have a paper trading account and maybe signing up and having their own trading account, right?
Yeah. Yeah, absolutely. So if it's okay, can I put a screen in here, Juan, on where to do that? Yeah. So it's just a Google Chrome. I'm in the TradeHawk right here. See the URL up top. I can give you that another time. If you want to try paper trading, you can schedule a free tour with us. We do one of these kind of talks, which just the two of us, and we chat, and you can talk to us. Free paper trading right here. Okay, so you can have access to what you see here. Okay, in a paper trading environment where we give you, a virtual $100,000 US to play with and practice. Okay, and I highly recommending practice. So you can't make them. There's no mistakes. It's not real money. It's fake. You don't need an account. It costs you nothing. We really want you folks to learn. And I'm really a big advocate of helping out teaching, especially among the university students. What Juan and his team are doing is just phenomenal. I love it. I'm really a big fan of it.
Which, by the way, we have some news that we will let our users know soon, right?
Yep.
Good news about something that Tradier and Trade we're doing together.
Yep. Coming around the corner.
Well,
we unfortunately have the global virus we're dealing with, so we're just together at this point.
Yeah,
we're working through it.
Yeah, but we'll let you guys soon.
Awesome.
What's going on? And thanks so much. It's always great to have you here.
Thank you. Well, look for us. Everyone look for us on Options Brew. It's great. We have some really great guests, and Juan will be one of the guests one of these days, right, Juan?
Yeah, anytime.
Awesome. So love to have everyone watch an episode. It's on our YouTube channel too, the past episodes. So we're just getting it going. So there's only a couple episodes right now, but a lot of great folks coming forward. So look for that.
Well, thank you very much, Lex, and have a great week. Volatile markets, so I suppose you're making money, right?
Yeah, option traders thrive in chaos and volatile markets. That's where we do our best.
So. I know. You'll retire soon.
I wish. All right. Good deal.
Okay. Thank you very much, Lex.
Okay. Pleasure. Talk to you later, Juan. Thank you. Bye, everybody.
Bye. Gracias a todos los que estuvieron en los webinars el día de hoy. Recuerden, tenemos el